BRICS expansion and the challenge to the US dollar. What's next for the global financial system? What if the next global financial revolution doesn't start on Wall Street, but in Johannesburg, Sao Paulo, or Shanghai? In recent years, the BRICS alliance, Brazil, Russia, India, China, and South Africa, has evolved from a symbolic economic group into a potential disruptor of the US-led financial order. The conversation has shifted from cooperation to transformation. With the inclusion of new members like Saudi Arabia, Iran, and Egypt, the bloc now represents more than 45% of the world's population and a growing share of global GDP. But here's the critical question. Is BRICS truly ready to challenge the supremacy of the US dollar? And what does that mean for global finance, American influence, and your economic future? In this video, we break down why BRICS expansion matters more than you think, the dollar's dominance, and its growing vulnerabilities, the secret strategies behind de-dollarization, 3 powerful scenarios that could reshape the world economy. Stay with us to discover what's brewing behind the scenes and why it's not just about currencies, but power, control, and the future of money itself. Chapter 1. The Rise of BRICS 2.0, From Concept to Coalition. In the early 2000s, few outside the financial world paid much attention when a Goldman Sachs economist coined the term BRIC. It was simply a neat acronym: Brazil, Russia, India, and China, 4 fast-growing economies expected to dominate global growth in the 21st century. South Africa joined later in 2010, turning the group into BRICS. At first, it was nothing more than a symbolic alliance, a convenient talking point for economists and a photo op for political leaders. But now, more than 2 decades later, BRICS is evolving into something far more serious and potentially revolutionary. In 2023 and beyond, the BRICS bloc began expanding its reach and ambition, extending formal invitations to several new countries: Saudi Arabia, Iran, Egypt, the United Arab Emirates, Ethiopia, and Argentina. This marked a turning point. No longer just an acronym, BRICS has become a geo-economic coalition, a counterweight to the Western-led order dominated by the United States and the G7. From economic curiosity to strategic power block. What changed? 3 main forces are driving the transformation of BRICS from concept to coalition. Frustration with Western institutions. Developing nations have long felt marginalized by institutions like the IMF and World Bank. Despite contributing significantly to global GDP and trade, BRICS countries receive limited influence in the decision-making processes of these institutions. China and India, for example, have the world's largest populations and massive economies, but still trail the US and Europe in global financial clout. Weaponization of the US dollar. Over the past decade, the United States has increasingly used the dollar-based financial system as a geopolitical tool, freezing reserves, applying sanctions, and cutting countries off from SWIFT. While these measures served US strategic interests, they also pushed targeted nations, like Russia and Iran, to seek alternatives. Even countries that are not directly sanctioned began reassessing their exposure to a dollar-dominated system they can't control. Economic complementarity among members. The BRICS nations are not ideological allies. They differ in politics, religion, and culture. But economically, they are highly complementary. Brazil and Russia are rich in commodities. China is the world's factory. India provides tech and services. South Africa offers critical minerals. Now, with the inclusion of energy giants like Saudi Arabia and Iran, BRICS is building a vertically integrated economic ecosystem, capable of trading among themselves without relying on the West. This shift has led analysts to start referring to the group as BRICS 2.0, a more strategic, coordinated, and politically aware version of the original coalition. The scale of BRICS expansion. Let's break down what the expanded BRICS represents in numbers. Population, over 3.5 billion people, more than 45% of the global population. Global GDP, PPP surpassing the G7 in total purchasing power parity terms. Oil production, combined output greater than OPEC, thanks to the inclusion of Saudi Arabia, Russia, and Iran. Reserves and trade, increasing reserves in gold, foreign currencies, and local trade settlements. But this isn't just about numbers. It's about narrative, about creating an economic story that's no longer written in Washington or Brussels, but in Johannesburg, Riyadh, and Beijing. The inclusion of Middle Eastern powers is particularly significant. For decades, petrodollars, the trade of oil in USD, have been the bedrock of American financial strength. If BRICS nations start accepting alternative currencies for oil, the consequences for the global monetary system could be profound. BRICS Bank and parallel institutions. One of BRICS' most strategic moves has been the creation of the New Development Bank, NDB, in 2014. Based in Shanghai, it was designed as a direct alternative to the IMF and World Bank, offering financing without political strings. While still modest in scale, the NDB has issued bonds in local currencies, funded infrastructure across member states, promoted projects in non-dollar formats. The strategy is clear: build a parallel financial system that supports emerging markets on their own terms. Now, with the expansion of BRICS, the NDB is poised to become a central node in a new global lending ecosystem. Countries tired of Western debt traps may soon find a more flexible, politically neutral partner in BRICS-backed finance. Strategic unity, political diversity. Critics argue that BRICS is too diverse to function. China and India have border tensions. Russia faces global sanctions. Brazil swings between left and right political regimes. How can such a group ever act as one? Here's the catch. BRICS doesn't need perfect unity, it just needs shared interests. And on key issues, like resisting Western dominance, enhancing South-South trade, and pushing for multipolarity, these nations are surprisingly aligned. They don't want a single government or ideology. They want a world with options, where economic power isn't concentrated in a few hands. BRICS isn't a replacement for the West. It's an alternative, and for many countries, that's exactly what they've been waiting for. Looking ahead, the evolution of BRICS marks a fundamental shift in how the world organizes economic power. It's no longer just about GDP or military might. It's about influence without domination, cooperation without coercion. As BRICS expands, it may not always move in lockstep. But it doesn't have to. What it offers is a platform, a stage where the global South finally gets to speak with a louder, unified voice. And in the years to come, that voice may reshape everything from how we trade to how we think about money itself. Chapter 2. The US dollar, still king, but for how long? For nearly a century, the US dollar has reigned supreme over the global financial system. From oil and commodities to sovereign debt and international trade, the dollar has been the heartbeat of global commerce. Its strength has anchored confidence in markets, giving the United States unparalleled power, not just economically, but politically. But history teaches us one thing: no empire lasts forever, and no currency enjoys permanent dominance. Today, the question isn't whether the dollar is still king. It is. But the more urgent question is, for how long? The rise to dominance. The dollar's ascent didn't happen by accident. After World War II, the Bretton Woods Agreement established the US dollar as the world's reserve currency, backed by gold. Even after President Nixon severed the dollar's link to gold in 1971, its role remained unshaken, thanks to America's economic strength, deep capital markets, and, perhaps most critically, the petrodollar system. By ensuring that oil-producing nations like Saudi Arabia priced their exports exclusively in dollars, the U.S. created sustained global demand for its currency. Whether a country was importing crude from Kuwait or buying steel from Brazil, it needed dollars to transact. That system did more than make the dollar indispensable. It gave the U.S. three strategic advantages. Global demand for U.S. debt. Countries accumulated U.S. treasuries to build dollar reserves, helping to finance America's deficits at low interest rates. Sanctions and financial leverage. The U.S. could cut off adversaries from SWIFT and freeze dollar assets, using the financial system as a powerful foreign policy tool. Trade and investment dominance. From hedge funds to central banks, global players trusted the dollar as a safe, stable store of value. But that trust is beginning to erode, and BRICS is leading the charge. The weaponization of the dollar. Ironically, it's the very power of the dollar that is now contributing to its vulnerability. Over the past 2 decades, the U.S. has used its financial leverage in aggressive ways. Sanctioning Iran, cutting it off from dollar trade. Freezing Russia's central bank reserves after the invasion of Ukraine. Targeting Chinese companies with financial restrictions. While effective in the short term, these moves sent a powerful message to the rest of the world. The dollar is not neutral. If your policies conflict with U.S. interests, your access to dollars can be revoked instantly. This realization has triggered a quiet but determined movement across the globe. Countries are beginning to ask, what's our plan B? The dollarization, a growing momentum. The idea of de-dollarization has gone from fringe theory to strategic policy across emerging markets. China has signed dozens of bilateral trade agreements allowing payment in yuan, including energy deals with Russia, Iran, and Saudi Arabia. Russia, since 2014, has aggressively shifted its reserves into gold, yuan, and rubles, reducing dollar exposure. India is exploring rupee-based trade settlements with partners across Asia and Africa. The EU and ASEAN are quietly promoting alternatives like the euro or regional digital currencies for cross-border payments. While these efforts are still small compared to the dominance of the dollar, they represent a critical trend line. The world is actively seeking alternatives. In fact, in 2023, for the first time, the share of global foreign exchange reserves held in dollars dropped below 59%, its lowest level in over 25 years. Meanwhile, gold holdings by central banks hit record highs. Why the dollar is still strong, for now. Despite these shifts, let's be clear, the dollar is not collapsing anytime soon. Here's why. Liquidity. The dollar is still the most liquid, widely accepted, and traded currency in the world. Trust in U.S. institutions. Despite political dysfunction, the U.S. legal system, financial transparency, and rule of law still attract global capital. Military and political power. The dollar is backed not just by GDP, but by geostrategic dominance. Even countries critical of U.S. foreign policy, like China and Saudi Arabia, continue to park trillions in U.S. assets. But because there's still no complete replacement. The Chinese yuan lacks transparency and convertibility. The euro is politically fragmented. Digital currencies are still experimental. And no BRICS currency, common or otherwise, has yet emerged. So while the dollar's grip may be weakening, it still anchors the system. Cracks in the foundation. That said, the cracks are growing. Rising U.S. debt, America's ballooning national debt, now over $34 trillion, raises concerns about long-term fiscal stability. Can the U.S. continue to print dollars indefinitely without consequences? Overreach in sanctions. The more Washington uses financial restrictions as weapons, the more countries look for escape routes. Technological disruption. Blockchain-based settlement systems and CBDCs, central bank digital currencies, are changing how trade happens, potentially bypassing SWIFT and the dollar altogether. Fragmented global trade. As supply chains regionalize and geopolitical blocs harden, trade in local currencies becomes more viable and strategic. This is where BRICS plays a vital role, not by replacing the dollar with a single currency overnight, but by normalizing alternatives. That's the real threat, not a sudden collapse, but a slow erosion of dominance. What it means for the U.S. and the world. If the dollar loses its unique status, the implications are massive. The cost of borrowing for the U.S. government could rise. Inflation may become harder to control as foreign demand for treasuries weakens. American consumers could face higher prices as the dollar's purchasing power declines. Washington's leverage in global affairs would diminish, changing the geopolitical balance. For the average American, it might feel like a loss of privilege. For the rest of the world, it may feel like a return to balance. But perhaps the real lesson here is this. Currency dominance isn't just about economics, it's about trust. And once that trust begins to fray, history shows us that change becomes inevitable. Chapter 3. The BRICS currency ambition, dream or disruption. For decades, the global economy has orbited around a single star, the US dollar. But in recent years, whispers have grown louder from across the global south. What if we created our own system? Not just alternatives to the dollar, but a completely new currency designed by and for emerging economies. In 2023, during the BRICS summit in Johannesburg, that whisper turned into a headline. Leaders openly discussed launching a common BRICS currency, one that could be used for trade, investment, and even reserves outside the dollar system. The implications were enormous. Was this the birth of a new financial world order? Or was it just political posturing? Let's break it down. The vision: a BRICS currency built on real assets. The idea isn't entirely new. For years, economists have speculated about a multipolar currency system, a world where regional blocs conduct trade in their own units, instead of relying on the dollar. But the BRICS proposal is different. According to leaked discussions and official remarks, this isn't just about using local currencies. It's about creating a new, shared currency backed by real assets such as rare earth metals, oil and gas, agricultural commodities, sovereign guarantees. This commodity-linked currency wouldn't be fiat in the traditional sense. Instead, it would reflect the resource wealth of BRICS nations, like Saudi oil, Russian gas, Brazilian soy, and South African gold. The goal is simple: to build a trust-based alternative that offers real value in global trade. Think of it as the anti-dollar, not based on debt or military power, but on tangible economic output. How it would work, in theory? While official plans remain confidential, economists close to BRICS policy circles have proposed frameworks for how the currency might operate. Issued by a BRICS Central Clearing Authority. A joint institution, possibly linked to the new development bank, would issue the currency and manage reserves, setting conversion rates. Used for cross-border settlements. The currency would be used primarily for trade between BRICS nations. For example, China could buy Saudi oil using the BRICS unit rather than dollars. Backed by a commodity basket. Instead of being tied to a single resource like gold, the currency could be pegged to a diversified basket of strategic assets, protecting it from volatility. Digital infrastructure. It's expected to be launched as a digital currency, possibly on a blockchain framework, to allow fast, secure, and transparent settlements across borders. What's driving the push? De-dollarization strategy. With BRICS members like Russia, China, and Iran increasingly marginalized by the Western financial system, a shared currency is a path to monetary independence. Stabilizing trade. Many emerging economies suffer from dollar fluctuations. A BRICS currency could offer more stable pricing mechanisms for critical imports and exports. Geopolitical leverage. A successful alternative to the dollar would reduce U.S. influence, especially over countries that feel constrained by dollar-based debt, SWIFT restrictions, or Western sanctions. Unlocking South-South trade. Intra-BRICS trade is growing rapidly. A common unit could streamline settlements and promote investment flows among members without the friction of currency conversion. But can it really work? This is the million-dollar, or perhaps multi-trillion-dollar question. And the answer isn't simple. Here are the main challenges. 1. Political fragmentation. BRICS members are not a political union. China and India have border tensions. Brazil swings between left and right-wing leadership. Russia faces Western isolation. Aligning on monetary policy and fiscal standards will be incredibly difficult. 2. Economic asymmetry. China's economy is larger than all other BRICS members combined. Would a BRICS currency be dominated by the yuan? That's a concern, especially for countries like India or South Africa that fear economic overreach by Beijing. 3. Infrastructure gaps. Unlike the euro, which evolved within a single market with shared regulations, BRICS members lack harmonized legal and financial systems. Building a common currency framework from scratch would require massive technological and institutional cooperation. For global trust. For any currency to succeed internationally, it must be seen as credible and stable. That requires transparency, predictable governance, and liquidity, factors the dollar has spent decades building. BRICS would have to earn that trust. Is it a threat to the dollar? Not immediately. The dollar still accounts for over 80% of global trade settlements, around 60% of global central bank reserves, the vast majority of cross-border lending and borrowing. But this isn't about instant disruption. It's about long-term erosion. If the BRICS currency is even partially successful, used just for internal trade, energy pricing, or development lending, it would represent the first real challenge to the dollar's monopoly since the fall of Bretton Woods. And the more countries that join BRICS or align with its trade principles, the greater the momentum behind such a currency. We may be witnessing the beginning of a parallel system, one that doesn't seek to destroy the dollar, but to create options, and with it, a new balance of global power. The digital dimension. An important aspect of this plan is the shift toward digital finance. BRICS countries are already experimenting with central bank digital currencies, CBDCs. China's digital yuan is live and in use. India is piloting its e-rupee. Russia has tested its digital ruble. Blockchain-based settlement systems. Russia and Iran are working on joint platforms to settle trades outside SWIFT. Cross-border payment rails. BRICS members are pushing for payment infrastructure that doesn't rely on US-dominated networks. A BRICS currency would likely launch digitally first, using smart contracts and real-time settlement to bypass banks and third-party intermediaries. In many ways, it could leapfrog the traditional banking system altogether, especially in underserved regions. What's next? The most likely path forward is incremental. More BRICS members will settle bilateral trade in local currencies. The new development bank will increase lending in non-dollar formats. Digital payment platforms between BRICS countries will reduce dependency on SWIFT. Over time, these systems could converge into a functional BRICS currency, especially if geopolitical pressure intensifies. In short, BRICS won't topple the dollar overnight. But it doesn't have to. All it needs to do is offer an exit ramp. And for dozens of countries caught between dollar dependence and national autonomy, that might be all they need. Chapter 4: 3 Futures. Where is the global financial system heading? The dollar is still the world's reserve currency. BRICS is still an acronym. But beneath the surface, the foundations of the global financial system are shifting, slowly, quietly, and inevitably. Now that we've explored the historical dominance of the dollar and the BRICS movement toward a new currency, the question becomes more urgent than ever. What comes next? In this chapter, we'll explore 3 realistic scenarios for the future of global finance. Each scenario is grounded in current trends but paints a very different picture of how the next decade could unfold. Scenario 1: Peaceful multipolarity. In this future, the global financial system evolves into a multipolar structure, where the US dollar remains dominant but is no longer the sole pillar. BRICS doesn't replace the dollar, but it creates credible alternatives. China settles its energy imports in yuan. Russia and India use the BRICS currency for trade within the bloc. African and Latin American nations begin pricing commodities in regional currencies. The new development bank expands its lending portfolio in digital BRICS units, offering lower-cost alternatives to IMF or World Bank programs. Meanwhile, the U.S. adapts. The Fed and U.S. Treasury strengthen regulatory frameworks for digital currencies. The U.S. dollar becomes partially digitized and more compatible with blockchain infrastructure. Washington reduces the frequency of financial sanctions to maintain global trust. In this world, the dollar remains a critical player, but not the only one. Reserve portfolios diversify. Currency risk is spread across multiple regions. Cross-border transactions become faster, cheaper, and more localized. Winners. Emerging economies gain more control over their financial futures. U.S. companies remain global, but operate in a more competitive environment. Multinational trade becomes more resilient, with less dependence on a single currency. Risks, if not carefully managed, fragmented standards and incompatible payment systems could create confusion in global markets. Scenario 2: Financial Cold War. This is the scenario where financial fragmentation becomes not just economic, but geopolitical. Here's how it happens. The U.S. continues to weaponize the dollar through sanctions and trade restrictions. China, Russia, and Iran develop closed-loop financial systems, independent of SWIFT and the Western banking architecture. A digital BRICS currency launches and gains traction among countries seeking to hedge against U.S. influence, like Turkey, Argentina, Nigeria, and even some Southeast Asian states. The world splits into 2 competing financial ecosystems. Western Bloc BRICS Bloc. USD, Euro, JPY BRICS currency, Yuan. SWIFT, IMF, BIS new platforms via BRICS Plus. Wall Street financing NDB and state banks. Capital movement becomes politicized. Corporations are forced to choose sides. Financial data is firewalled. Currency convertibility is limited. Investment flows slow down. Globalization doesn't collapse, but it reverses direction. Trust breaks down between blocks, and financial markets become increasingly regionalized. Winners: governments that can control their capital flows and domestic inflation. National champions in tech and finance within each bloc. Losers: small economies caught in the middle, unable to navigate two separate systems. Global corporations facing rising transaction costs and legal uncertainty. This world is less efficient, more volatile, and shaped by national interest over open cooperation. Scenario 3: the fall of the dollar. This is the most extreme and least likely scenario, but it's one that cannot be ruled out. In this future, the United States fails to maintain trust in its currency, not because of BRICS pressure, but due to domestic mismanagement. Ballooning debt, over $40 trillion, triggers investor panic. A major sovereign credit downgrade shakes confidence in treasuries. The Fed loses control of inflation amid rising geopolitical risk. Foreign central banks dump dollar reserves in favor of gold, commodities, or the BRICS unit. Global commodity markets begin pricing oil, wheat, and metals in alternative currencies. The result? The dollar loses its reserve status. Treasury yields spike. The U.S. faces a currency crisis similar to what developing nations have experienced for decades. Import costs rise. Domestic inflation surges. The American standard of living drops. For the first time in a century, the U.S. imports inflation instead of exporting it. Winners: commodity-rich BRICS countries with export-driven economies. Countries with diversified reserves and strong domestic markets. Losers: the U.S. middle class, hit hardest by rising prices and economic contraction. Countries heavily reliant on dollar-denominated debt. This scenario would mark the end of the Pax Americana and usher in a chaotic transition period where no single currency dominates. Which scenario is most likely? Based on current data, the most realistic path is Scenario 1, a peaceful but irreversible shift toward multipolar finance. BRICS doesn't need to overthrow the dollar. It just needs to offer viable alternatives. The U.S., while still powerful, must learn to share space with rising economic powers. Digital technologies make currency competition more agile and more transparent. Trust, not brute force, will determine the next era of financial leadership. However, elements of all three scenarios may appear simultaneously. In Africa, Latin America, and Central Asia, de-dollarization is already accelerating. In Eastern Europe and East Asia, economic decoupling is progressing due to geopolitics. And in the U.S., rising debt and political polarization are eroding long-term financial confidence. So while the future may not be binary, it is undoubtedly in transition. Final thoughts. The only constant is change. Currencies are more than paper. They are symbols of trust, power, and the rules of the game. For 80 years, the U.S. wrote those rules. Now, BRICS and its allies want a seat at the table, and perhaps a chance to write a few chapters of their own. Whether that ends in balance or breakdown will depend not just on what happens in Beijing, Brasilia, or Moscow, but on how Washington responds. History is watching. The question is not if change will come, but how well we will adapt when it does. Final chapter. A new financial era, secrets, shifts, and the bold steps ahead. Across the world, from the corridors of Washington to the energy markets of Riyadh, a quiet revolution is unfolding. It's not just a change in currency, it's a challenge to the very structure of global power. We've taken you through the journey. How the US dollar rose to dominate after World War II. How the BRICS alliance is building momentum through strategic expansion. The dream of a shared BRICS currency backed by real assets. And 3 sharply divergent scenarios for what might happen next. But now it's time to step back and answer the question behind it all. What does this mean for the world, for America, and for you? Let's close this story by sharing what few are willing to say out loud, the hard truths, hidden opportunities, and the real future that's already beginning to take shape. Secret number 1. Dollar dominance was never guaranteed. The US dollar's rise to global supremacy wasn't purely because of strength, it was because of circumstance. After World War II, Europe was shattered. Asia was rebuilding. The US held most of the world's gold, the world's strongest military, and the only intact industrial base. The dollar became the world's benchmark by default, not by vote. But dominance created complacency. The US started running persistent deficits. Sanctions became overused political weapons. Trust in American leadership began to erode after repeated global crises, from Iraq to the 2008 meltdown to the debt ceiling showdowns. Other nations watched and began building options. The truth is, the dollar's greatest strength has always been global trust. And trust, once lost, is hard to rebuild. Secret number 2. BRICS isn't just about money, it's about sovereignty. When leaders from Brazil, Russia, India, China, and South Africa sit at the same table, they are not just negotiating trade deals, they are declaring independence from a Western design system. For decades, many countries have felt they were playing in a game where the rules could be changed without warning by decisions made in Washington or Brussels. The push for a new currency is, in essence, a push for economic self-determination. BRICS doesn't promise perfection, but it offers what many developing nations are desperate for, a choice. That alone is powerful. Secret number 3. America still holds the cards if it chooses to use them wisely. Here's the truth the doomers won't tell you. The United States is still the most powerful economic actor on Earth. It has the world's deepest capital markets. It still issues the safest assets, U.S. Treasuries. Its currency is used in 88% of global trade transactions. And American innovation, especially in fintech, AI, and energy, remains unmatched. What America lacks isn't capacity, it's discipline. The U.S. must decide whether it will reinvest in the credibility of the dollar through fiscal responsibility, modernize its financial system to embrace digital currency innovations, rebuild diplomatic bridges and respect the sovereignty of emerging markets, or ignore the signs and allow rivals to reshape the system from the outside. In the end, the dollar's greatest defense is American leadership. Not through domination, but through integrity. Real-world lessons from behind closed doors. In 2022, a quiet meeting took place in Dubai. Delegates from several African and Gulf nations discussed something unprecedented: pricing oil in non-dollar terms. It didn't make headlines. But within 6 months, the UAE, Saudi Arabia, and Egypt all expressed interest in joining or aligning with BRICS. This wasn't ideological. It was strategic. These nations want leverage, not isolation. And the BRICS framework offers a counterbalance they can use to negotiate better terms, even with the West. Meanwhile, American financial executives, from New York to Silicon Valley, have started hedging exposure by investing in digital infrastructure overseas. They see what's coming: a more decentralized, more competitive, and more digital financial world. The smart ones aren't betting against the dollar. They're betting on adaptation. The bold step forward. What should we take from this? This isn't a call to panic. It's a call to awareness. If you're a business owner, prepare for currency diversification in trade and supply chains. If you're an investor, study how BRICS developments are impacting commodities, sovereign debt, and regional ETFs. If you're a policymaker or voter, demand transparency, fiscal discipline, and global cooperation from your leaders. If you're a citizen, know that your financial future is tied not just to what's happening in Washington, but to choices being made in Johannesburg, Beijing, and beyond. The world is no longer binary. It's becoming networked, multilateral, and contested. And in this new landscape, the bold don't wait for change. They shape it. Final call to action. At Bold Steps Forward, we believe in revealing not just what's happening, but why it matters and how to prepare. If you found this deep dive insightful, make sure to subscribe for more global financial breakdowns. Like and share this video to spark real conversations. And comment below. Do you believe BRICS will succeed in challenging the dollar, or will the US reinvent its leadership in time? Because in this era of global transformation, staying informed is no longer optional. It's essential. Thanks for watching, and until next time, keep taking bold steps forward.